While silver bleeds out on your screen, while the fear merchants scream about the metal's crash, there's another metal that refuses to break. $5 orders 86 per pound. Holding, not rallying, not collapsing, just holding. I am Ken Au. Welcome to the vault. Today, Amazon just bypassed every exchange on Earth. And by the end, you'll see the $5.50 floor that changes everything. January 16th, mid-afternoon. Your ticker is painting the story they want you to see. Gold down $21. Silver crushed, minus 3.15%. The headline writes itself. The commodity supercycle just hit a wall. The metals mania is over. Retail panic. Exit signs flashing. But here's what they're not showing you. Copper, 586, flat, stable, unmoved. While paper traders are liquidating precious metals in terror, and while the algorithms are dumping contracts, while the fear index is spiking, there is one metal sitting there like it's bolted to the floor. And that kind of stability in the middle of a bloodbath tells you something the screen will never admit. There are very large hands underneath this market, and they are not letting go. This is where things stop making sense. This is where things stop making sense. Gold, the ultimate safe haven, the 5,000-year store of value, it's sliding. Every defensive asset is getting hammered. Every fear trade is reversing. Think about what you're seeing. Silver, the retail darling, the Reddit stack, the prepper's insurance policy, it's in free fall. But copper, the industrial workhorse, the cyclical commodity that's supposed to collapse first when recession fears hit, it's holding $5.86 like there's a bid wall made of concrete. This isn't normal market behavior. This is structural intervention. This is what happens when the physical market and the paper market stop speaking the same language. The screen is telling you to sell. The shadow market is telling you something completely different. And while you were watching that red flush, while the talking heads were writing obituaries for the metals trade, something happened that should make your hair stand up. Amazon Web Services, AWS, they just signed a 2-year direct offtake deal with Rio Tinto, not through the LME, not through the COMEX, direct, bypass the entire public market. Lock in supply, guarantee delivery. Samsung did the same thing. These aren't trades. These aren't speculations. These are strategic acquisitions of a resource that the world's largest tech companies have decided they cannot afford to be without. Let me ask you something. If copper is just another industrial commodity about to crash with everything else, why are the biggest corporations on the planet locking in multi-year supply contracts right now? Why are they willing to pay above market rates to guarantee delivery? Why are they bypassing liquid, transparent exchanges to secure metal directly from the mine? Someone knew. This move was prepared. Because what's happening right now isn't a commodity rotation. It's a reclassification event. Copper is no longer being treated as a commodity. It's being treated as strategic tech gold. And the institutions are front-running the public before most people even realize there's a shortage coming. Let me show you the mechanism they don't want you to see. The copper to gold ratio. It's the economic seesaw. On one side, you have gold, the fear asset, the bunker mentality, the thing you buy when you think the world is ending. On the other side, you have copper, the build asset, the infrastructure metal, the thing you need when you're constructing the future. When the ratio falls, the market is rotating into defense, recession, crisis, fear. When the ratio rises, the market is rotating into offense, growth, building, infrastructure. And right now, that ratio just completed a technical correction pattern. He seesaw is tilting. The market is shifting from bunker mode to build mode, from preservation to projection, from insurance to offense. The institutions see this, AWS sees this, Samsung sees this. They're not waiting for CNBC to confirm the trend, they're positioning now. And here's where the math becomes unavoidable. Every electric vehicle uses 80 kilograms of copper, 4 times more than a combustion engine. Global auto production, 80 million vehicles per year. If just half transition to EVs over the next decade, that's 2.4 million metric tons of new copper demand, just from cars. But it doesn't stop there. A single large AI data center requires 5,000 to 10,000 metric tons of copper. Microsoft, Google, Amazon, Meta, they're all building hundreds of these. Every watt of AI computing power requires copper to keep the system from melting. Renewable energy grids, solar farms, wind installations. A single offshore wind turbine uses 8 metric tons of copper. The IEA projects we need to triple renewable capacity by 2030 just to meet baseline climate goals. Add it up. EVs, AI infrastructure, renewable grids, baseline industrial demand. You're looking at multi-decade locked-in demand that hasn't existed in human history. This isn't cyclical. This isn't discretionary. This is structural. This is oxygen for the electrified future. Now let's talk about the other side, supply. New copper mines take 12 to 15 years to bring online, exploration, permitting, Environmental reviews, financing, construction, ramp up. That's not an estimate, that's the average timeline. And here's the killer. Ore grades have dropped 30% since the year 2000. Mining companies have to move 30% more rock to extract the same amount of copper. The easy, high-grade deposits are gone. What's left is deeper, lower grade, and exponentially more expensive to extract. So demand is accelerating. Supply response time is measured in decades. And the gap between them is widening every single quarter. S&P Global just published the number. Cumulative supply deficit by 2030, 10 million metric tons. That's not a rounding error. That's a structural abyss. And the institutions know this. That's why AWS bypassed the exchange. That's why Samsung locked in 2-year contracts. That's why the London Metal Exchange inventories are quietly bleeding out while official numbers still look stable. This is moving into a dark inventory phase. The most important metal on Earth won't even be available on public markets because it's already been allocated to long-term corporate contracts. You think you can just buy copper on the COMEX when you need it? Ask AWS. They didn't think so. That's why they went direct. That's why they locked in 2 years of supply. That's why they're willing to pay premiums above spot. They've done the math. They know what's coming. But let me pause here. Let me address the strongest argument against this. Recession will kill demand. If we hit a prolonged global manufacturing slowdown, if credit tightens, if governments pull back on infrastructure spending, then all this EV and AI and renewable talk evaporates. Copper, being cyclical, would get crushed. Fair point, legitimate concern. But here's where that argument breaks down. The direct corporate deals prove that tech giants don't care about the PMI. They care about availability. AWS isn't speculating on copper prices. They're not trying to time the cycle. They're de-risking their supply chains because they know that if they wait for prices to crash and then try to secure supply, the supply might not be there. This is the key difference. In past commodity cycles, demand was fungible. You could defer projects, delay construction, wait for better conditions. But the infrastructure demands driving copper today are not fungible. They're not optional. If you're Amazon and you need to build a data center to support your AI services, you can't just delay that indefinitely. Your competitors are building. You're either securing copper now or you're falling behind in the AI race. If you're an automaker and you've committed to transitioning your entire fleet to EVs by 2035, you can't pause that because the economy hit a rough patch. You're locked into massive capital investments, retooling factories, training workers, signing supply agreements. This is locked-in demand. Could a recession slow the pace? Sure. Could it delay some projects? Absolutely. But it can't eliminate the structural need for electrification. The world has made a collective decision, driven by climate policy, technological advancement, and energy security, that the future is electric. And that future requires copper. So even in a recessionary scenario, you're looking at a temporary demand slowdown, not a structural demand collapse. And here's the supply trap. If we enter a recession and copper prices soften, what happens? Mining companies cut exploration. They delay new projects. They focus on maintaining existing operations rather than expanding. And when the economy recovers, which it eventually will, the supply deficit is even worse than before. You can't idle a mine development project and restart it quickly. Once you pause, you're adding years to the timeline. So the recession argument, while valid for near-term volatility, actually reinforces the long-term structural case. Now let's talk about recycling. The optimists say recycling will save us. Copper is infinitely recyclable. Sounds reasonable. But here's the metallurgical reality they ignore. Recycled copper cannot meet the high purity standards required for the most demanding applications. AI data centers require ultra-high purity copper for cooling systems and high-speed interconnects. Next-generation EV motors require copper with extremely low impurities to maximize efficiency. You can't just melt down old pipes and wiring and use it for these applications. The metallurgy doesn't work that way. You need virgin material. Recycling will meet a portion of overall demand, but it cannot fill the gap for the high-tech, high-growth sectors driving the structural increase. And then there's China. China's economy is slowing. China consumes 50% of global copper. If China goes into prolonged slowdown, copper demand collapses. Again, legitimate concern. But here's what that misses. China is also the world's largest investor in renewable energy and EV infrastructure. Even as their property sector struggles, they're massively ramping up solar, wind, and grid-scale battery installations. Traditional industrial demand might soften. Electrification demand is accelerating. And beyond China, you have India, Southeast Asia, parts of Latin America in the early stages of their own infrastructure build-outs. The geographic distribution of copper demand is shifting. It's becoming less concentrated in China and more distributed globally. A Chinese slowdown would hurt, no question. But it wouldn't eliminate the global structural demand story. So having addressed the bear case, here's my conclusion. Key recession argument is valid for short-term volatility. If we hit a severe downturn, copper prices could pull back. But the structural supply deficit is real. The locked-in demand from electrification is real. And the inability of supply to respond quickly is real. If you're thinking in weeks or months, sure, there's recession risk. But if you're thinking in years, if you're trying to position for the structural megatrend, the bear case does not hold up. Because at the end of the day, you can't print copper mines. So what happens next? I'm watching the LME closely for changes to margin requirements. When physical inventories decline and volatility increases, exchanges raise margin requirements. This squeezes out speculative leverage. If we see margin hikes at the same time shadow withdrawals are accelerating, that's a signal the paper market is under stress. And when the paper market is under stress, price discovery breaks down, shadow withdrawals. That's the key term. The LME reports inventory levels, but those numbers only show what's in registered warehouses. They don't show copper being pulled into private corporate stockpiles through direct offtake deals. The AWS deal, that copper isn't showing up on the LME. The Samsung deal, not on the exchange. You can have a scenario where official inventories look stable, while actual available supply for spot transactions is evaporating. This is the dark inventory phase. The most important metal on Earth won't be available on public markets because it's already been allocated to long-term corporate contracts. If that sounds far-fetched, look at what happened in lithium. Major auto manufacturers signed multi-year direct supply agreements with miners, bypassing the spot market entirely. Copper is heading in the same direction. And expect the media to stay laser-focused on silver's volatility. Why? Because volatility generates clicks. Fear generates engagement. A 3% down day in silver is a headline. A steady grind higher in copper over 6 months? That's not a headline. The narrative will be about the metals crash, the end of the commodity supercycle, the retail traders who got caught in the precious metals hype. And while everyone is focused on that narrative, the institutions will continue quietly securing copper supply through off-exchange deals. Classic misdirection. Keep the retail crowd focused on the shiny, volatile thing while the real move happens in the slow, boring thing nobody's watching. Here's the dashboard I'm monitoring. Number 1, LME inventory levels. If these continue dropping while corporate direct offtake deals rise, that's confirmation the squeeze is moving off exchange. I'm not looking for a dramatic crash. I'm looking for a steady, grinding decline that persists even when prices are flat or slightly lower. That would tell me price isn't the clearing mechanism anymore. Availability is. Number 2, the 550 floor. If copper holds above 550 per pound during the next broad market sell-off or risk-off event, that's confirmation the decoupling is permanent. It would mean copper is no longer trading as a pure cyclical industrial commodity. It's trading as a strategic tech asset with a structural bid underneath it. Number 3, the spread between futures and physical premiums. If physical premiums widen significantly above futures prices, that's a signal the spot market is tighter than the paper market is pricing in. This is what happened in the early stages of the oil super spike in the 2000s. Futures were pricing modest growth, physical barrels were trading at significant premiums because actual supply was constrained. None of this happens overnight. This isn't a GameStop-style short squeeze that explodes in a week. This is a multi-year structural trend that grinds higher in a way most people won't even notice until it's already happened. The price could chop between $5 and $6 for months. It could even pull back to $4.50 if we get a sharp recession scare. But the underlying fundamentals don't change based on short-term volatility. The supply deficit, the corporate positioning, the locked-in demand, those are structural. Here's what I think is most likely over the next 12 to 18 months. Continued volatility in precious metals. Gold and silver will have big up days and big down days. The retail crowd will get whipsawed. The talking heads will keep calling tops and bottoms. Meanwhile, copper will grind. It'll hold support. It'll have occasional spikes on supply disruption news. But mostly, it'll just not go down. And slowly, quietly, the corporate supply chain managers will keep locking in long-term contracts. The LME inventories will keep declining. The mining companies will keep reporting that new projects are delayed or over budget. And at some point, maybe late 2026, maybe early 2027, the market will wake up to the fact that there's a structural shortage. And that's when the real move happens. Not because of speculation, not because of a short squeeze, but because the physical market has already been cornered by the institutions and the price has to adjust to reflect the new reality. That's the playbook I'm watching. Now let me be very clear. This is not advice. This is not a recommendation. This is just me sharing my own line in the sand. I'm watching the copper to gold ratio daily. If it continues turning higher while silver is suppressed or range-bound, I'm personally rotating my focus from precious metals to industrial tech metals. That doesn't mean I'm selling all my physical silver. I've been stacking for 12 years. That's my insurance. That's my long-term wealth preservation. But in terms of where I'm looking for asymmetric upside over the next 12 to 24 months, I'm shifting attention to copper exposure. How do you get copper exposure as a retail investor? Physical copper. You can buy physical copper rounds or bars. Problem is storage and liquidity. Copper is bulky and heavy, not as easy to stack as silver. Copper futures or CFDs. Direct price exposure, but comes with leverage risk and rollover costs. Not recommended unless you really know what you're doing. Copper mining equities. This is where the asymmetry is for most retail investors. Specifically, the Global X Copper Miners ETF, ticker COPX. Diversified exposure to the largest publicly traded copper miners. Operational leverage to copper prices without single stock risk. Here are my specific triggers. Trigger A, if copper closes the week above 580 despite a broader market sell-off, meaning stocks are down, precious metals are down, risk appetite is negative, but copper is holding firm, I'm personally looking to increase exposure to COPX. Why? Because that would signal the structural bid is real. The institutions are defending this level. The decoupling is confirmed. I'm not trying to catch the bottom. I'm trying to confirm the trend before committing capital. Trigger B. If copper breaks below 520 on a sustained basis, not just a one-day flush, but a clean weekly close below 520, I'm sitting on my hands. That would signal the China drag is temporarily stronger than the AI boom. Recession fears are winning out over the structural story. I'd wait for a new base to form before re-engaging. I'm not interested in catching a falling knife. I'm interested in riding a confirmed structural trend. Stop. Look at the bid-ask spread on the copper CFD right now. The liquidity is drying up. Market makers are widening spreads because they're not sure where the next wave of buying or selling is coming from. And when liquidity dries up in a market that's supposedly in a bear phase, that's often a sign the bear phase is ending. This is where the battle is won. Not in the headlines, not in the CNBC soundbites, but in the bid-ask spread, in the open interest data, in the warehouse withdrawal reports that get published at 4 a.m. that nobody reads. So here's my plan in simple terms. I'm watching copper daily. I'm monitoring the copper to gold ratio weekly. I'm tracking LME inventories and corporate supply agreements as they get reported. If copper confirms strength above 580 despite broader market weakness, I'm rotating into COPX with a position size. I'm comfortable holding through volatility. If copper breaks $5.20, I'm out. I'll reassess at a lower level. And in the meantime, I'm keeping my physical silver stack intact. That's my insurance policy, not my growth trade. The goal isn't to get rich quick. The goal is to position on the right side of a multi-year structural trend that the market hasn't fully priced in yet. Because here's what I've learned over 12 years of doing this. The biggest moves in commodities don't happen when everyone's watching. They happen when the institutions are quietly positioning and the retail crowd is distracted by something shinier and more volatile. Right now, silver is the shiny, volatile distraction. Copper is the quiet, structural move. And I know which one I'm paying attention to. 3-sentence recap. Silver is the headline, but copper is the long chapter that comes next. The AWS and Samsung deals are the first drops of a coming corporate tsunami where tech giants bypass public markets entirely to secure strategic supply. The macro rotation from precious metals to industrial tech metals has already begun. The market just hasn't announced it on the ticker yet. Here's my final forecast. Over the next 12 to 18 months, I expect copper to grind higher in a way that frustrates both bulls and bears. It won't be a clean, dramatic rally. It'll be a choppy, range-bound slog that slowly builds a higher floor. But underneath that surface chop, the structural forces are aligning. Corporate supply chains are tightening. LME inventories are declining. New mine development is stalling. And the demand from EVs, AI data centers, and renewable grids is accelerating. At some point, the paper price will have to reconcile with the physical reality. And when that reconciliation happens, it won't be gentle. I'm not saying copper is going to $10 per pound tomorrow. I'm saying $5 per pound is the new floor for a world that has no choice but to electrify. And if you understand that, if you really internalize what it means for critical infrastructure metal to transition from commodity status to strategic asset status, then you understand why the institutions are positioning now. Don't let the red flush on your screen blind you to the tectonic shift happening in the dirt. The era of copper is just another industrial commodity is over. The era of copper as strategic tech gold is here. And while the mainstream media is writing obituaries for the metals mania, the smart money is hardwiring the future with the one metal that can't be printed, can't be synthesized, and can't be substituted. You can ignore it. You can wait for confirmation from CNBC. You can tell yourself this time is different and the supply deficit is overblown. Or you can look at what AWS is doing, what Samsung is doing, what every major tech company building the AI-powered electrified future is doing. They're securing copper directly off exchange at above market rates. They're not speculating, they're not trading, they're acquiring a strategic resource they know they cannot afford to be without. And the question you have to ask yourself is this: are you going to position for the world as it was, or the world as it's becoming? The metals crash narrative, that's for yesterday. The copper supply crisis, that's for tomorrow. And tomorrow is closer than most people think. If you want to understand why the inventory is disappearing faster than the exchanges can report it, if you want to see what's happening in the shadow vaults and the corporate supply chains, you need to be watching this space, because the institutions have already made their decision. The only question is whether you'll make yours before it's too late.